Good day, ladies and gentlemen. This is Barry Norman on behalf of Investing.com, and welcome to our class, or our two-part class on swing trading. Since most of you that actually wrote in and responded to my earlier question is, did you attend last week's class, said you did not, or you were not available, I'm going to real quickly run through what we covered last week because you have to have a consistent foundation here to move forward. So I'm going to really quickly run through last week's class, and then we'll move forward on to today's class. So that way you understand the basic concepts of swing trading. Because unfortunately, a lot of people mix up swing trading and day trading, and they really have no similarities to each other. Okay. Swing trading is the concept of trading swings in the marketplace. And most swing traders hold on for trades way longer than one day. They usually trade for between 2 days and 10, maybe 2 days and 30 days, where day traders are looking to get in and out of many positions within the same day. So Wikipedia describes swing trading as a speculative trading activity in the market whereby instruments such as currencies are bought and sold at or near the end of an up or a downtrend swing. That is it. Swing trading is simply buying on the tops and the bottoms of uptrends or on the peaks and valleys between price movements. Okay. As opposed to day trading. Day trading uses many different strategies to make trading decisions because you're looking for short-term gains, where in swing trading you're actually looking for very large gains in the marketplace. So a day trader trades intraday and he buys on peaks for it to move up by the end of the day and sells as soon as it does, where a swing trader buys for days and weeks charts and would buy at the same peak, but he would look to close that position down the road where he would have gotten a lot more profit. So swing trading is different from day trading because when swing traders trade, they leave their trades running for more than one day, even to a month or so. So swing trading technique is a short to intermediary term following trading technique. Generally, swing traders look for minor trend reversals to enter trades in the direction of the main trade. The nicest thing about swing trading, it doesn't require intensive work. It doesn't require you, like day trading, to be attached to the markets 24/7. Swing trading is a lot less stressful. Swing trading gives you the time to make proper analysis, to enter and then leave the market without panicking or stress. Now with swing trading, it is easy to take profits and easy to put stop losses because you actually place your stop loss a bit farther away from the market price to avoid getting stopped out prematurely, and also you take profits at a place a bit farther away so your risk to reward ratios are always 1 to 2 or higher. Swing trading is much easier to learn and do than day trading. Trading transaction costs due to spreads are much lower than that of day trading because of a less trades placed. A day trader to make 200 pips is probably going in and out of the market 4, 5, 6 times, whereas swing traders entering the market once and leaving the market. So his spread costs are a lot less. Now, swing trading doesn't take a lot of your time. You can place your trades and walk away instead of babysitting your trade like a day trader. Swing trading is much less stressful. Profits made are much larger in day trading because you let your trades, profits in swing trading are much larger than day trading because you let your trades run for more than one day. Also, if the markets move slightly against you, you're not forced to close your position. You can wait out a blip in the markets because a swing trader isn't forced to close a position. Swing trading allows swing traders to ride out the trend for maximum profit extraction using the best trailing stop techniques. And the thing about swing trading is you're simply using what we call trailing stops to constantly move your stop loss up as the asset moves in your favor, whether it's an uptrend or a downtrend. You constantly move your stop losses closer and closer. So at some given point, your stop loss is above your entry level. So therefore, you've already locked in your profit and you let your trade keep riding till it gets to the top or the bottom of the trend. And even if the markets reverse on you, your stop loss has now been moved into where you're guaranteed profit. So I prefer swing trading. And there will be times that I day trade, but I like looking at the big picture. And for me, swing trading is ideal for that. I'd rather be making 100 to 200 pips profit per trade than 10 pips per trade and making lots and lots of them. Day trading stresses me out. Day trading requires continuous analysis, using lots and lots of stuff and having lots of money on the table. So that's what I like. For you, you may like day trading. So the answer is to this question is really, it's you to decide. But if you're wondering who is more profitable, swing traders or day traders, the answer is both can be profitable. It's one is labor and time intensive where the other one isn't. And also swing trading is easier for a novice or a beginning trader. So swing traders use time frames that are much longer. You generally hold your securities for a few days or several weeks. You still have to make sure that you're in a favorable position, but you have some breathing room. It's entirely possible to profit from swing trading on a part-time basis while holding down a full-time job. Okay. This flexibility makes it a great option for people who want to learn how to trade profitably and don't want to devote their lives to it. Swing trading is a very nice trading method. Now, swing trading is in itself a strategy, where day trading is simply a definition of the type of trading that you're doing today. And that's another thing that traders get mixed up. Swing trading is a strategy based on buying and selling at the highs and the lows or the eases in a trend. It is establishing a price trend, and then every time the price eases off of that trend, because the markets move in peaks and valleys, so it's locating the proper valley in an uptrend to buy back in until it goes in that uptrend, and then when it hits that peak, sell it again before it goes into another valley. Okay. So that is a basic strategy. Now, it does require you to understand and know a great deal about trends and retracements and breakthroughs, whereas day trading is simply a style of trading. It doesn't, for day trading, you have to build your own entire strategy. It's got the word day trading or the term day trading has nothing to do with the strategy you are employing. Now, a swing trader depends on three emotions that dominate the market: greed, fear, and uncertainty. Now, that's not their own greed, fear, and uncertainty. These are the three emotions that dominate the markets. These emotions can cause virtually all the short-term price aberrations that make swing trading a profitable technical strategy. Swing traders try to ignore the tendency to react emotionally to price movement using logic to take advantage of market overactions. When prices rise, the market tends to act out of greed, buying to get in on anticipated profits. Now later, we're going to see the cycle, the actual cycle, and this is the basics of how to trade swing trading. So let's start out with some fairly simple rules, and I know I'm going very quickly, but we have a lot to cover today, and since we're backing up and doing a review of last week, we're just having a lot of stuff. So remember, swing trading is about trading with, and I'm going to use it, with the trend. Always go in the direction of the major trend. Yes, you have heard this over and over, but let me give you specifics. Sit across the room and see if you can see which direction the market is moving. Only take trades in the direction of that trend. There are other ways to determine if a market is trending one way or another. You can also use a simple 50-day moving average and see what side the trend is on. This is usually the side you want to be on. Don't swing trade against the main trend. Even when trades go against you, they tend to gravitate towards the main trend. So going that direction from the start can save you a bad trade from being a loser. You are able to get out of the markets with a smaller loss and will increase the odds of trades going in your way. Statistically, if you trade with the trend, no matter how you're trading, you will make more pips and be more consistently right. So if you don't believe me, take a look at a stock that's heading down sharply and wait till a positive story comes out. The stock will rally for a few days, act like it's moving up, and then it'll fall once again in the direction of the main trend. It doesn't happen every time, but it happens enough where it's far from random. Also, with swing trading, do not trade dead markets. One of the first things you want to do is find a market that's got movement, activity, and volatility, because otherwise you won't be able to trade successfully, because this is all that swing trading is about. Trades must be moving in a trend. That doesn't mean they're kind of holding a position. That doesn't mean they're range trading. They've got to have movement, because if they don't have movement, then you're just wasting your time. Many swing traders trading from beginner's book to recommended traders only trade long sides that they feel comfortable with. Now, there are two directions of any market. Okay. Many traders only tend to enter the markets in long positions. That means in an uptrend, because selling short or downtrends confuse the hell out of them. You need to understand and learn the understanding or the consequences, or be able to understand the concept of selling before you buy. In other words, selling into a downtrending market, because otherwise you're cutting out half the potential trades. Now, if you only feel comfortable in trading up or buying now to sell later, that's fine. It's a human rational thing. But if you conquer sell now to buy back later, in other words, selling in a downtrending market, you double your chances of finding a right market to trade in. Okay, now, the other thing is you want to pay attention to correlation. Correlation is very important. What is correlation? You don't want to necessarily paying the Euro USD, the Euro Japanese Yen, and the Euro GBP. You don't want to necessarily be trading Facebook, Google, Twitter, all at the same time. Because the markets tend, unless you see some specific reason that the opposite is going to move, you're just doubling your risk. Because if the overall tech market is going to be moving up, all of those assets will be moving up. If for some reason you think Facebook's going to be moving down, you might want to look at trading Facebook the same. But buying two nearly similar assets, you're just simply doubling your positions in the marketplace. It's a waste of your money and it's a waste of your risk. Just like if you're expecting the euro to gain momentum because Mario Draghi is going to say something, okay, decide which one it'll gain best again, or where you want to be trading it against, the pound, okay, or the Japanese yen or the euro. But you don't want to trade the euro Japanese yen, the euro pound, and the euro US dollar, because then you're just tripling your positions and tripling your risk. Okay? And so you're therefore tying up a lot of your money. So keep in mind, trading highly correlated assets is the same thing as doubling your position. Don't do it. Make sure you do a simple correlation analysis and make sure that the market you are trading do not have a high degree of correlation to each other. Okay, I've got some guy in here, I don't know what kind of English, ain't sharing your screen. Is that deliberate? No, it's not deliberate, and everybody else is seeing the screens fine. So if you're not seeing the screens, it's most likely your connection. I would log out and log back in, or refresh your screens. Okay, so what we needed to determine are the components of a swing trade. First, we have the selection of the asset. Then we go to trade setup. We go to determine the entry point, our initial stop loss, our exit points, and how we're going to move up our trailing stop loss, and lastly, our position size. These are all the determinations we have to make before we enter a trade. Now, the first determination you have to make is understanding who is control of the market. Is it a bull market? Is it a bearish market? Not only is it in an uptrend or downtrend, who is actually in control? You're looking for big money moves. Okay. Generally speaking, big players want to accumulate a position on longer term moves. It takes weeks or months to build these big positions. Luckily for us, there is a chart that lets us know exactly what they are doing and when it's obvious for us to consider a new swing position. And that is called volume. When we look at volume, we can see who is controlling the markets. A candlestick chart also tells us if the big money is supporting higher prices or dumping new shares on the market, creating lower prices. A candlestick chart is genius in its simplicity, yet powerful if you have the discipline to take its readings as absolute. A candlestick chart shows us the relationship between high, low, open, and close of a symbol during a specific period. In today's lesson, we're going to be looking at monthly charts. In other words, the high price, the low price, and the first trade of the month and the last trade of the month. Okay. Now, does technical analysis really work to produce high probability ideas, or do we simply look to see what we want to see? The concept supporting technical analysis is that price discounts the news. We believe as technicians that all factors determining the correct price are already baked into the current price. So now we want to know if technical analysis will help us determine if the long-term trend is still relevant, because that's the only thing we're really concerned about when we're looking for swing trading. We're looking to buy in dips of the trends and when the price is moving up, and we need something that will help us verify that the trend is still valid and still moving. Okay. Now, two common methods of doing this are candlesticks and moving averages. Typically, you want to employ one chart that defines a trend and a second that defines an entry point. This allows you to interpret when big money is supporting a stock with new highs and higher lows, and a second chart that allows you to manage. To many of us view technical analysis as a system to make money. It's not. I know that sounds like I'm contradicting myself, but I am not. Chart reading gives us and helps us locate profit targets, risk points, and probabilities. It's up to us to manage the trade. The real money is developing trade management skills. The true opportunity for swing traders is learning how to adjust positions and set expectations for share size, trade duration, and how many positions are correct for any market condition. Okay. Technical analysis works. It's a valid strategy. The last ingredient to make it a money-making solution for you. So that's what it is. Technical analysis is simply an ingredient factored into your trading recipe. Now, many short-term traders make the mistake of reading the net change of the previous close. This is wrong for most swing traders because you want to know the buying and the selling pressure in the most current window. You want to know the change from the open. This might sound confusing, but here's why. The last price of a candle could be trading higher than the last price of the previous candle, but it could be a giant red candle. This would tell us massive selling pressure is taking place. We want to be a buyer when the monthly candle is green, because that's telling us the overall monthly price movement is up. The more green, the better. Now, there's many interpretations of candlesticks, and candlesticks factor into many, many trading systems. And candlesticks themselves are a system, but in swing trading, there are specific signs that we're looking for within the candles. In this scenario, not only is the strong green, but the high from the month is higher than the last month, and the low is higher as well, as indicating. If you're looking at weekly charts, same thing. Daily charts get a little bit more confusing because swing trading is based on longer term trends, but it still holds true. You want to look for, in an uptrend, that the green from the previous close is higher than the last previous in this current candle. Look for these two simple but powerful setups before you look for an entry signal, and you'll be stacking the odds in your favor. Now, what we want to do is we need to locate what's called the swing highs and the swing lows. Now, if you notice here, the markets move in these peaks and valleys, and this is the thought you have to understand. Okay. Let me get back. Okay. So here we have a peak or a thrust. Then we have the ease back. We have the thrust back. We have the ease. We have the thrust. We have the ease, the thrust up, and the ease again. And this is how a good uptrend should be. Now, the rule of thumb is the ease down should never be lower than the previous low. So this is what tells you you have a good uptrend, and this is telling you the ease of the highs and the lows. You're then able to start building a channel also. Okay. But this means that a swing trade buyer would be looking to buy from these swing lows to capitalize on the movement up or the longer term movement to here. So a day trader would be looking to enter here and get out before this happens. We don't really care as a swing trader. We know that there are eases in the market. We know there's thrust. We would be looking to enter every time we had this ease. So here's your thrust up, ease. We want to enter at this ease. We want to buy back into the up, ease, buy back into the up, ease, buy back into the up. Okay, and at some point we would be going into a sell position, but not in this point. What we'd also be doing is constantly moving our stop losses up. Okay. So this position, if you had entered this position here and hypothetically put your stop loss around here, when it moved up this high, you'd be moving your stop loss up with it. As it moved up here, as it moved up here, you don't know where this high is. So when it does ease down, okay, your stop loss would have taken a place, and the system would have closed out your trade here, or you could have put your stop loss to the next candle down here and you would have stayed in the market. But at any point, if the markets fell, you would have been stopped out at profit. Because if the market stop loss was here, you would have exited the market at this point. If you entered it here, exited there on the down, you still made a sizable amount of profit. And then you could have waited till it hit a new swing low to re-enter the market. Okay. And it gives you a lot of advantages. A solid swing trader, though, sets a stop losses far below. So his stop loss would have been somewhere down here. Then he would have trailed it up. But he wants to capitalize on this full movement. Okay. Because that's a lot of profit. If you would have entered the market here and sold here, you would have made a lot of pips. So again, we have the buy swings. Each time it swung down, you would have bought into the market, and you keep buying into the market. Okay, so here you have your seller swings, your swing sells here. You would have been out of the market. Here you would have had the end of your downtrend market, and now you've moved into an uptrend market, and you would have been buying on each one of these valleys or easements in this to exit the market here. Okay. And this price movement was about a 30-day movement. Okay. A swing trader, he doesn't panic. He's not worried about getting stop loss because he's not trading small pips. When you're looking to make 200 pips profit, you know that the market's going to peak up, peak down, peak up, peak down. Okay. So here, if you would have watched thrust, ease, thrust, ease, thrust, ease, thrust, ease. Now, we're going to define this cycle in a second. But you need a plan. You just don't make this up as you go. Okay. And you need to combine it with one or two other indicators that will help you understand when the markets are dying, okay, when the swing is dying. Now, one of the strongest rules of thumb is volume, which goes in the bottom of your chart, will let you know what the markets are doing. As price is moving up steadily, volume should continue the same look as the price rise. If the volume starts to deteriorate, Means lots of people are leaving that market because they don't believe it's going to continue. And that's when you would want to consider exiting the market, because you cannot predict the exact bottoms. You can't predict the exact tops. You can't predict ahead of time the exact swing highs and swing lows. Okay. So what we'd be doing is looking for a clue that the market is about to reverse. And there are many indicators that we can combine with that are very accurate to tell you when the markets are overbought or oversold. So we can combine many things, like a combination of moving averages, a 40-day, a 20-day moving average, and when we have the crossovers, okay, and these are called convergences, they give us specific clues about the markets. Okay. So a combination of multiple moving averages is one of the scenarios that you could use. Some people, for longer term trades, use a 20-day and a 200-day moving average. But if you notice on the bottom here, you see volume. Volume is your ultimate importance. A simple one moving average simply moves the noise out of the markets. It lets you know what the real price of the asset is. But here in chart 2 on Intel, okay, we see the moving averages moving up, giving us, and then when we see the price fall and touch that 20-day moving average, the 200-day moving average, it's telling us a very specific thing about the market. And that's telling us that downtrend has reached its bottom. But you have to develop your trading plan of what signals you're going to use, because you don't mix and match them. You don't say, I need something right now, and you're going to go out there and find it. Part of building your swing trading strategy or your swing trading plan is what indicators you will use for what. Now, for our purposes, there are two types of trading: wealth trading and income trading. Okay. Most of swing trading is all about income trading. Okay. We are only going to focus today on income trading. Market players use more than one time frame in his or her analysis will experience a higher degree of trading accuracy. Remember this, as it's important in key understanding of why a perfect setup in one time frame may not work and fails many times. Now, there are 4 major styles of trading in each market. Under each market, we have the wealth building style and the income producing style. Now, under wealth building, we want to look at core trading as weeks to months, and we'd be using weekly charts, where swing trading is usually 2 to 10 days. It can be considered a wealth building style of trading is designed to capture short-term swings in an ongoing trend while sidestepping the brief counter trend moves. Okay. And they use daily charts. Swing traders buy near the declining 20-day moving average and sell away from the 20-day moving average. Okay. You can also use, if you're trading commodities channel index. That's a secondary indicator that will help you see a buy and a sell position. But the most crucial thing to any of these systems is volume. Okay. Now, the peaks in volume, regardless of whether you're using a commodities trading trend or you're using whatever indicator you're using, it is volume, which are the red and green bars below, that help give us indications. See where the volume spiked? Look at what happened here in the price chart. Okay. Now, when we have a gap, that tells us something specific. Now, we have to understand candlesticks. Now, if you're not very strong about understanding candlesticks, okay, we have several classes available to you. I think we're running a class later this month on basic candlesticks. You need to have a very good understanding of them. But candlesticks help you really understand what is happening in the markets for swing trading. Now, they determine who's winning the battle. Okay. When you have green candles, the bears are winning. When you have red candles, the bulls are winning. But the wicks are very important to tell you who pushed the asset in one direction or the next. Bulls and bears cannot consistently win more than 5 battles in a row. They get tired out. They're like human beings. You have a tug of war and you keep doing it over and over. Statistically, after 5 times that the bears won, the bulls will get one in. So each side typically surrenders to the other after 3 to 5 battles are won. If the bulls or the bears win significantly more than 5 battles in a row, a catastrophic loss will be priced in and paid for the abnormal winning streak. So we can actually see this in the candles. But there are some general clues that we can see in candles that help us understand the trends. But when we see either the 3-bar rally, the 4-bar rally, or the 5-bar rally, we should be looking to exit the market or buy into or sell into the market, because these are the pictures of greed, and the bulls will at some point get burned out. So this is where we would want to take care of the markets. And this is what we're looking for when we talked about the emotions. This is the perfect picture of greed, because they will keep buying in because they want to make all the profit. When you see these 3 bars up, the people jumping into the market are the people looking for greed. It's usually the headlines are driving them. They're saying, look at that, look at it. Everybody's buying into gold. I'm going to buy and gold. They're the stragglers. When you see 4, he's getting really, and if you ever see 5, it gives you a perfect sell position. Okay. The same thing in the reverse scenario. Okay. Whenever we see 3, 4, or 5 strong candles in a row down, okay, the bulls will, or the bears are eventually going to lose out. Okay. Now, I'm going to reveal to you a few simple keys to understanding how the markets work. The following concepts form the cornerstone of any and every sound trading technique or tactic. After gaining a clear understanding of these building blocks, the trader will never again find himself confused or not knowing what to do. In fact, once these powerful and simple concepts are mastered and understood, the trader will rarely find himself on the wrong side of a trade. And over 65% of the trading losses can be attributed to being on the wrong side of the market. And after the fact, you can look back and say, uh-oh, I know what was wrong. So if we look, the market has 4 specific stages. And this is the only movement that a stock or an asset can make. There's no other motion possible. The entire cycle of a stock is comprised of this cycle, or a security, repeated time and time again. The cycle forms the basis of predicting price movement. The basic unit helps the traders know the current status as well as what's next. The key to trading successfully is knowing where you are in the cycle. And this is the only way that this cycle is to play this cycle successfully, and only way one can also lose. There are buy areas and there are sell areas. Okay. You need to evaluate the market, whether you're looking at a 1-day chart, a 1-week chart, or a 1-month chart. Okay. Again, you have to determine the strategy you're going to use. Once you've done this, you don't go back from one to the next to the next. Okay. You determine, I'm going to look at the euro, or I'm going to look at Apple, and this is how I'm going to look. Trying to adjust your charts to make you have a buy position is only going to give you a false reading. So the first thing you have to do is actually identify, and preferably using at least a 1-hour or 1-day chart, and 1 day is the most preferable. Or if you're going to trade longer, a 1 week or a 1 month. The longer the trade period, the more successful you're going to trade. But it also means the longer you're going to have to stay in the market. Okay. Now, once you're able to identify this overall movement, you can then determine where you fit in the current cycle. So in stage 2, our plan focuses on buying. Once we've established stage 1 and we see it moving to stage 2, we would be buying into the market. At stage 3, once we verify that stage 3 has actually existed, we would be selling. So in stage 4, our plan focuses on shorting the market, selling it to go down. In stage 1 and 3, we focus on both buying and shorting. Stage 1 to stage 1 can span over decades. That's stage 1 here to stage 1 here. Now, it can span over decades if you're looking at long-term trends, or it can span over minutes if you're looking at short-term trends. You have to apply this to the trading time period you are using. Now, the cycle is made up of 3 primary trends, and you have to learn to look, and it's time-consuming. It doesn't happen instantaneously. You have to learn to identify these. Okay, so the only way to win is traders who consistently have simply learned to play the cycle this way. Identify and buy in the buy area, correct in the sell in the short area. The only other way to lose is to buy towards the top in the wrong stage and sell when you're at the bottom. Okay. And that's because they didn't properly or spend the time looking for the cycle. Okay. And it holds true all of the time. So one of the best educational things you can do for yourself is starting to try to identify these. So take a one-day chart on any of the assets. If you like to trade commodities, look in commodities. If you want to trade stocks, look at your favorite stock and try to find these. Now, the full cycle. Now what we're looking at is a 1-month chart. Okay, we're looking actually at a daily chart. Okay, and we can see price entering stage 1. We can't see stage 1 till it enters, but stage 1 usually comes off of a range trading, a sideways trend. We move up into stage 2. We come to stage 3. We move to stage 4, and we come back into stage 1 again. So this is the identification of the full cycle. And this happens all the time. And the whole idea is to figure out where you are in that cycle, whether you're using a 1-day chart, a 1-week chart, a 1-hour chart. You have to identify where you stand in this. Okay, not, okay, well, I have a downtrend here. Okay, and that's all you simply care about. No, is that downtrend actually the end of stage 3 moving into stage 4, or is it something different? You know, once you identify these, because swing trading is different. This is what you need for swing trading. This is not applying trends and candlesticks to other types of trading. This is the basics of what's called swing trading. Okay. Now, we can see that right here on this chart. We moved into stage 1 up to stage 2, moving to 3, we fell down to 4. We have volume down below supporting our entry and exit levels. We have our buy here, our buy here. We have our peak, our valley, our thrust, our ease, our thrust, our ease, our thrust, and our ease. Okay. A lot of you keep writing in, what time frames? Like I just said to you, this chart would look the same if you're looking at a 1-day chart. You'd still need to identify the same pattern. It's still laid over top of whether you're looking at a 1-day chart, a 1-month chart, or a 1-hour chart. Okay. If I were to take off this bottom down here and black it out to you, you would have no idea whether you were looking at a 1-hour chart, a 1-day chart, a 1-week chart, or a 1-month chart. So if I said to you, you're looking now at a 1-hour chart, would you know any difference? Nope, you still need to see the same thing. If I told you you're looking at a 1-day chart, would you know any difference? Nope, you still need to see what it looks like in that 1 day. Okay. Now, the thing is, remember we talked earlier using multiple time frames. One, to help you identify patterns, and the two, to help you get entry and exit points. And now we see the full completed cycle of the four-step cycle here on this screenshot. Now, there's important points about each one of these stages. There is only one cycle in existence. Stocks and other markets can do nothing else but comply with the cycle. No other movement or motion is possible. This is the first major key to predicting market movement. And remember it. This is it. This is not a hypothetical. This is not Barry's rule. This is the rule of the markets. There is no other cycle in existence. There just isn't. The cycle is made up of four distinct stages, which in turn are driven by four distinct emotions or psychological stages. The four stages must and always do occur in the same sequence. This is always an important key to price prediction. Number one, the bottoming period is driven by uncertainty or ambivalence. This is the stage during which traders are unsure or indifferent. The interest level starts low. Okay, you have to find this. This is when usually you see range trading stocks, or even if it's in an uptrend or downtrend, it's a very small movement. Okay, this is the easiest start to identify. This is when the beginning of this cycle is happening. Stage two, the bullish period, is driven by greed. This is a stage during which traders will make the most money. The mindset that dominates stage two is one that wants to be in the game at any cost. Most participants will make money during stage two, except those who come out too late or for those who stay in too long. So you have to be able to identify stage two. It's your critical buy point. It's your critical entry into the point. Because if you start to wait till it gets to stage three, you're going to be entering the market way too late. Stage three is the topping period. It is also driven by uncertainty and ambivalence, just as in stage one. During the stage, sentiment begins to change as a growing number of players begin to doubt the stock or the market's ability to continue upward. Now, it doesn't mean it's going to fall. It's where you do not want to be entering the market, and when you exited the market, when you did enter the market down in the beginnings of stage two, you want to be ready to exit here. You don't want to stay in the market while the markets determine whether they're going to push up or push down, because we're uncertain. Stage four is the bearish period, is driven fairly by fear, which typically escalates or crescendos into a climax. So remember, the downtrend is always the second part of the cycle. So if you're seeing a downtrend in the markets, back up to where you can see the beginning of the cycle with the uptrend that allowed that asset to trend down. Important, there's only one way to lose. If a trader thoroughly understands this one way to lose, he will be more prone to avoid it. Okay. Those who enter the market enter late, typically exit late, but they exit all at once, which in turn creates a climatic part of the decline. Once this last batch of traders exits, the worst is over. Okay. Now, a stock or the market can only be in one of the four stages at any given time. Identifying which stage of a stock is in is vital to successful trading. It helps to reduce losing trades and adds a quality to one's decision making that is very high. The astute trader will make most of his profits during stage two or stage four. Stage four is when you're selling into the down market. Stage two is when you're buying into the up market. Keep in mind that each stage calls for a specific trading strategy. The successful market player has a collection of approaches for each stage. The four stages are divided into four transitional phases. The transitional phase tends to be the most difficult and points to trade. There are whiny, choppy, and very volatile. Okay. This means when after you enter stage two, okay, Stage 2 is going to be a very strong buy. Then it's going to go into a transitional stage before it actually reaches stage 3. Okay. Once it reaches stage 3, it's going to be in this transitional stage. Then the market's going to take a decision, and you'll be able to understand it while it moves to stage 4. The highest degree of market mastery will be obtained when the trader learns how to handle the transitional phases A, B, C, and D, as well as the 4 stages. Because remember, there are only 3 things an asset can do: go up, go down, or go sideways. So the 3 primary trends in existence: uptrend is defined by a series of higher highs and higher lows. So in other words, we talked about it before, it is the peaks and the valleys, the thrust and the ease. Thrust, ease, thrust, ease, thrust, ease, thrust, ease. You won't see a market go that way. If you see a market that goes thrust, ease, thrust, ease, thrust, ease, thrust, ease, it's not usually an uptrending market. You need to have, in most cases, higher highs and lower lows. Okay. The rule of thumb is that the low, when the market eases, should never fall below the previous swing low. So in other words, here's your first swing low. Okay. Here, market's pushed up and ease back down to here. When they push up, this easement here should not come below this line. It should be relatively higher. Pushed up, because this is the story of the uptrend, because otherwise you don't have the uptrend. Okay. You have just the exact opposite when we are in a downtrend, which is defined by a series of lower highs followed by lower lows. The exact opposite. Okay. Now, then we have the sideways trend, defined by a series of relatively equal highs and lows. The sideways trend is better known as stage 1 and 3. Okay, so if we back up, you have stage 1 and 3, you have stage 4, and you have stage 1. So what do you have? You have the cycle. Stage 1 and stage 3. Stage 2 is right here, is your uptrend. Stage 4 is your downtrend. So we can define both stage 1 and stage 3 as range trading or sideways trading. And this is what will help you identify for what you're looking for when you're looking for this in an overall chart pattern. Now, when we see it on a chart, so we can see here is A, B, C, D. Here is thrust 1, ease. Thrust 2, ease. Thrust 3, ease. Thrust 4, thrust 5, ease, down. Okay. So the transitional phases are A, B, C, D, and E, and the thrusts are 1, 2, 3, 4, and 5. So an uptrend is defined by a series of higher highs and higher lows. So each one of these, in an uptrend, you would actually draw your downtrend, connecting as many of those swing highs as you can. Now, the uptrend is defined by a series of higher highs and higher lows. Now, this would be a part of our cycle. What we do is we start our cycle here, and now we're moving in to stage 2 of the uptrend. Okay, stage 1 is over. Now, these 1, 2, 3, and 4, and 5 are just your highs. These are not your stages. Okay, these are just your high swing highs. We're in stage 2. This is what we would look for. It's coming off of a range trading, and we're looking to identify stage 2. Okay. And this is moving up. So we've now verified a good trend. Once it starts to move in a sideways undefined pattern, we would know that we're now in stage 3. Right now, this could continue up in this direction. What we're looking for to see where it is. Now, there's many different buying clues that are in here that we could use to buy. every time it hits down at an AB, a swing low, we would be buying into this uptrend all along stage 1. Okay, now stage 2. But we have to understand when stage 2 actually goes into its transitional phase. So its strongest would be here, here, and here. Now, if we notice here, it's starting to lose some of its momentum. It's still in an uptrend, but it's not making the pips you would have made from this point forward. And this is the transitional in that stage. So stage 2 uptrends, we have the highest high, the lowest low, the highest high, the lowest low. And again, we dip down here into a new low, but we are looking for identifying the transition, okay, moving into stage 3. So here we move in from stage 2, from stage 1, and then we start stage 2. So now the uptrend is defined again by a series of higher lows and lower lows. We can use a price correction, which is what we see right here. This is the ease between. Okay, this is a time correction or a sideways movement. Here we have another price correction here, which is the ease or the peaks and the valleys. So we have down, sideways, time correction. So this is now the beginning of the uptrend is right here. And this is now moved into stage 2. At this point, we see a price correction and we want to see whether we're starting to move into stage 3 or starting to follow forward with that stage 2 higher. This is where we would want to consider maybe selling and exiting the markets. We would have made nice profit. We would have made profit from here all the way up to here. From that point on, we would then expect the asset to start moving in from stage 3 down to the downtrend and identifying the downtrend as a series of lower lows. Again, peaks and valleys, but in reverse. Ease, thrust, ease, regain, ease again, regain, ease again, regain, ease again, regain. Now this was actually used retracement levels, and we can actually see these at the exact 50% levels because we have to use something that would help us put our stop loss and our take profit points on here. Let me get my markings off of here. Okay, so we want to combine these building blocks into our cycle. So there's only one cycle of movement any asset can make. We call that the atom. The cycle is made up of 4 stages. These 4 stages are made up of 3 primary trends: an uptrend, a downtrend, and a sideways trend. Each trend should have its own matching trading action. So we start out again. Now we put those patterns right on this cycle chart. So here we have the sideways pattern where we have the peaks and the valleys not reaching higher highs or lower lows. We then start moving into the buy area where we start moving to an uptrend where our peaks are higher than our next peaks. Our swing lows don't go any lower. And we've moved into what looks like our standard uptrend movement. We then move over to a sideways trade again in stage 3. And what do we see? The peaks, the highs and the lows remain the same. And then we move into the downtrend, which is the exact reverse of the uptrend, which then ends at our range trading area. So this is stage 1. This is stage 1 of the new cycle. This is stage 3. This is stage 2. And in the uptrend, we would buy on the dips. So in other words, when the price thrust up and it dipped down here, this is a buy point. Price thrust up, dip down here. This is a buy point. Price thrust up, ease back down, buy point. Thrust up, Now it didn't ease back down. It went into sideways action. So now we're thinking about exiting the market. Now, each trend should have its own matching trading action. And that means that you should have other indicators, whether it's just volume. Volume's a great indicator to let you know that you should be, or the markets are about to make a change. So therefore, things like RSI and stochastics, which are bounded oscillators, work extremely well in sideways moving markets. They tell you when the market is about to break out. Okay. They will tell you the market, in this case, is overbought, and it will move into a sideways action. Okay. When it goes into that sideways action, they will tell you the market is getting ready to move down, that is oversold. Most indicators work very well coming off of range trading movements. Okay, so we've looked at up and down trends. I need to move through this a little bit faster because we've talked about all this over, and we've got a lot to cover in a very few minutes. Okay. So let's talk about some buy and sell setups. The key buy setup is made up of only a few basic criteria. This setup is the key to capturing big 1 to 5 bar trading gains on the upside. A trader can often use this one step alone to buy without another guide. Okay. To key buy setups. 1, for 3 or more consecutive lower highs. Okay. Major emphasis is on highs. Okay. Not necessarily the color of the candle. We're looking at each high is lower than the previous high. Okay. 3 or more consecutive lower lows. So we're looking at the price was lower in each one of these. So you have candle 1, okay, which the high was lower than candle 2, and then candle 3. The low, which is down here, is the wick, was lower each time than the previous, regardless of how long the wick is. Okay. Now, what's this also look like? We looked at these 3, 4, and 5 candlestick moves. This is telling you also in a 3 candlestick move, this is just setting the rules. And you have 3 or more consecutive dark red bars. At times, it is acceptable for the close to be above the open of the last day. Now, what does this tell you? Anybody guess what this is telling you? This is giving you the buy action. Buy when the stock or the asset trades above the prior day's high, or buy when the stock trades above its first 30-minute high. Note, only use buy action 2 in the prior day's high. It's too far away. Place a stop at 0.5 or 0.10 cents below the entry of the day's low or the prior day's low, whichever is lower, using a trailing stop under each prior low after 2 completed bars. In other words, you'll use your trailing stops to move it up and up. But this is not a sell signal. It's a buy signal. The price objective is met. The reversal bar has developed or a gap has occurred. So this is when you would start using your. So when we have the 3 candles that give us all that we want, we would then enter here at a buy signal. Okay. We would buy 5 cents to 10 cents above the prior day's high. So here's the prior day's high. Let me take these off. We would want to wait till that asset is 5 to 10 cents higher. Or if you're trading in currency, 5 to 10 pips. If you're trading in commodities, you have to figure out the correlation there. Okay. Once you have it above, you would then enter the buy market. You would put your stop loss at 5 to 10 cents below the current or the prior day's low. Here's the prior day's low. So you would have a stop loss here, and you would enter the market here. Okay. What were you? You were in the stage 4 and it's now moved into stage 1, moving up to stage 2 again. Now, the chart shows a key perfect buy setup. The green arrow points to the buy bar. The red line signifies where the pristine trader places his stop. The key buy and sell. So we have coming in off of stage 1, and we've moved to stage 2. Here is your buy candle, the green line here. Here is your stop loss, and your target area would be here, the highest high before it reversed course. Okay. So what you look for is 3 consecutive lows, which are our number 1, which is right here. Okay. When we get the next green candle and the high, the candle moves to green and it moves above the prior day's close, we would set our entry point at 5 to 10 cents or 5 to 10 pips above the high from yesterday. Enter the market here. Target point would be here. Exit point would be there. We would be very happy with profit to here. Stop loss would be down here at the bottom of the previous candle's low. The chart shows 2 perfect buy setups. The green arrows point to the buy bars. The red lines signify where the trader places his key buy setup, his stops. Okay. 3 consecutive lower highs and lower lows in number 1 and number 2. Both of these gave us the same signals. Stop loss, entry point, target point. Entry point, stop loss, target price. Now, there are many rules you can use. We're looking at a daily chart also. There are many, many rules you can use. There's many trading systems you can use. Each one is completely unique, and you have to learn to apply them. I'm only showing you one of the most popular techniques to enter with swing trading. Now, in this case, you would have been in the market here for about a week. Same thing here, you would have been in the market for about a week. I'm sorry, I can't get my marker to turn off here. Okay. So the key short setup is made of only a few basic criteria. The setup is the key to capturing big 2 to 5 day trading gains to the downside. The trader can often use this one setup alone to short without other guides to trade. So we looked at buy. Now we're going to look at the opposite side of shorts, and it's the exact reverse. We have our 3 candles, okay, with higher lows and 3 candles with higher highs. So we see them marked in A, B, and C. Then we have 3 or more consecutive light green bars. Okay, so we have all 3 of these tickers in place. We have our candles 1, 2, and 3. We have A, B, and C. Now note that this setup is a minor stage 2 uptrend. The stock has 3 or more higher lows. Okay. Short the stock when the stock trades below the prior day's low. Okay. Doesn't matter about the candle. You've got your 3 A, B, and C candles. In the next candle, what you're looking for, and it could be not the next candle, it could be 2 candles down, when the stock trades below the prior day's low, or short when the stock trades below its last 30-minute low. Note, only use short action 2 if the prior day's low is too far away. Again, as we did the opposite. Set your stop at 5 to 10 cents above the entry point, or 5 to 10 pips, or the correct percentage when you're using commodities. Use a scaling stop for each prior days and follow these rules. So, well, here you have it. Now start building your own trading plan. You know the rules of swing trading. You decide what indicator you want to use to support it. You decide if you want to use volume. Okay. You want to use it because I can only give you guidelines. After that, you have to start applying your own criteria. And I'll show you some charts with all of this put on live charts today and throw you different trading methods. Hold on, let me bring them up on the screen. So here you can see a perfect swing trader, okay, using volume, MACD, as well as Fibonacci retracements. Okay, following the exact same methods for trading the pound. This is a current chart. This is moving forward. This is, for trading this week. Okay. We can also see in gold. Again, we have the perfect round. Now in this case, look at all of these green candles we got. So we're waiting for the market to do what? We're waiting for the market to move into a downtrend if we get that fourth candle where it's lower than the previous open. In this case, we had a very strong downtrend. This is gold US dollar. It's moved into an uptrend, but it hasn't given us any signals. But you can see how beautiful this entire cycle has been. I mean, we went through all the way up to stage 3, down to stage 4, moved back over to stage 1, and now we're in a strong stage 2. Okay. So this valley here is your stage 1 from the previous run. Okay. Here was our stage. This is actually our stage 3 all across here. This was stage 3. This was stage 2, and we would have come off a stage 1. Okay. And identifying where you are, so we're actually now in a stage 2. So what do we talk about in the stage 2 cycle? This is where the buying power should be. We come off of 1, we're going into stage 2. Now you have to look at what price you want to enter the markets and where to put your stop losses. Okay. We have a very simple plan here with the USD JPY. Now we're in stage 3 in a hard downtrend. We see it actually, we can verify the downtrend. Push, thrust, push, thrust, push, thrust, push. Now we're expecting something to happen here. Lastly, we go into something more complicated, and here we put our buy and sell signals. This is the current USD CAD, and we've come off of this stage 3, and we're looking at it to move, but we don't know where it's going to be when it moves into a stage 1 cycle or it moves up to stage 2. So these are only our premonitions. These would be our estimated targets but we have to wait for price movement to let us know where we're going. Okay, so this is where we would like it based on Fibonacci retracement levels, trend patterns, and support and resistance levels, but we need to wait for it to take place. Here we've used multiple GAN fans. We used the GAN fan from the upswing and the downswing, and we've got price actually boxed in right here in this area and price boxed in here, but we're still waiting for something to tell us that it's a valid trade. So all of these are variations of interpretations of swing trading. So on that note, I'm going to leave all of you out there. Okay, and hopefully you'll come to more of our classes on technical analysis, trends, and everything else over the next month. We're entering class number 3 of our technical analysis class, and that is a lot on support and resistance and oscillators and indicators. So you should join us on Wednesday for that class. And then we're going into Elliott waves. Elliott waves works extremely well with swing trading, Elliott wave patterns. And we'll be actually talking about that in next Sunday and the following Sunday's class in our 2-week class on Elliott Wave. But believe me, you can't master any of this in 2 one-hour classes. We're just trying to give you ideas and understanding of what you can think about. Now, for those of you who asked, you cannot have my PowerPoint. The class has been video recorded. It will be uploaded and it will automatically be sent to you. There's nobody to call and get it from. There's no emails to send. Everybody who registered and attended the class will be sent this class when it is ready, and we will attach to it class 1 and class 2. So give it 3 or 4 days and you will receive it in your email. Please, next class, don't come up and say, Barry, I didn't get it. Because number one, I have no control over who gets it, but it's automatically sent. So if 400 people that registered or 600 people that registered got it and you didn't, it's most likely in your spam, your junk, or you just deleted it. And there's no person who's in charge of sending them out to you. So please watch your email. So thank you very much, and we'll talk to you again. Have a great trading day, and have a good week. Good night now, or good afternoon now.